My name is David Moore. I work for KCDF. KCDF is Kenya Community Development Foundation. We are a community development foundation based in Kenya with roots in East Africa and other continents across the world. So in East Africa, we specifically for this financial resilience resources hub, we have strong partnerships around just strengthening the capacities of CSOs in Uganda, Tanzania, and Kenya. So going back to the Financial Resilience Resources Fund, one of our partners, the Ford Foundation, has funded KCDF to work in partnership with the LightUp Impact and Femi Foundation to develop modules. One of them we will get the details today, to strengthen the capacities of CSOs to be able to serve their communities better. So basically, that's the main aim of the sessions that we will have today moving on. And of course, just as Jennifer did, we had other sessions before. I wish all of us a fruitful session.
It's an honor for me to introduce the trainer for today, Mr. Colin Muga. So Colin Muga is a financial management expert with over 5 years of experience helping SMEs become investment ready and secure funding. He has partnered with organizations like the World Food Program, USAID, UNICEF, and UNFPA to drive meaningful change in underserved communities across Uganda. Specializing in developing tailored financial management training manuals, Colin has conducted impactful sessions on record keeping, financial management account formulation, and strategic financial planning. His efforts have strengthened the financial stability and operational efficiency of organizations, contributing to their sustainability and empowering communities to build resilient futures. So it means today we have a trainer who really understands our need and it's ready to create impact on that space. Last but not least, with a steadfast commitment to creating lasting impact, Colin continues to equip organizations and communities with practical tools and strategies for sustainable growth. Without further ado, allow me to welcome Colin, who will be taking us through these trainings. Colin, I hand it over to you. I will be helping you in terms of just keeping time. So once in a while, you see me interjecting you so that at least we use our time together well, and then we can be able to be effective in the training for today. So you're most welcome, Colin, as you take us through the training.
Yeah, thank you very much. Good morning to everyone. As introduced, I'm Colin Muga, and I'll be the one taking you through this training for the next 3 sessions. So we'll have 3 sessions that we'll be trying to look at over this next training. And the first session is what we're going through today, which is understanding financial management. So basically today we're going to try and see why is financial management crucial. Actually, what is financial management at first? Why do we need financial management in our organizations? What are the key elements of good financial management and principles of financial management? So as you're trying to put different financial systems in your place, what principles should you try to follow? What are the building blocks? So building blocks are basically we're trying to see when you're trying to have a whole financial system in your organization, what blocks should you have in that financial system that can enable it to be functional for what you're trying to look to achieve, both in the short term and the long term. And then we'll finalize that with the tools of financial management. So during these sessions, of course, we're going to also have breaks where we'll try to get into activities to further have more activity from the participants as well as see areas on which we can try to better support you. And yeah, that's how the session will run. It's going to try to be a session of where we hear back from you, have some questions from your end, and based off what the time allows. So after this session, next week we'll have a session on financial planning and budgeting. And here we'll be trying to look at how do you start having these financial plans over financial year or over the next five years, where you want your organization to be. And of course, if you have a financial plan, you have to now come up with a budget on how you can really ensure that these plans come to life, because it then makes sense if you have a plan, but you have not budgeted on how, let me say, your incomes are going to come in to be in position to execute these plans. And under there, we also look at how do you try to keep records in your organization, because based off my experience supporting different SMEs, NGOs, we've realized this is a major pain point, trying to have those records kept properly in the right procedure to ensure they are accurate and ensure that they follow all the rules of accounting, to ensure that one can use this information actually to create decisions in an organization. So we'll try to look at that in the second session, which will be taking place 3rd Feb which is next week, and it will be still running at the same time. And the third session will also be next week, and that will be our final session, where we'll try to now look at financial reporting, compliance, and risk management. So financial reporting, there we'll just be trying to look at how do you use the financial information that you have built over time to now create reports that make sense to different stakeholders. So as NGOs, we have different stakeholders. It could be donors, it could be different investors, it could be the board, all who support in decision making. So we'll try to look at how that comes in. And as I know that I'm talking to NGOs, also know there are a number of grants that are taking place in the organization. So if you're able to now get these grants from different organizations, how are you trying to effectively use those and report on those to ensure that you are able to utilize a grant as well as also follow on to get another grant. And then we'll look at compliance, which now mainly targets if we have built up an organization, how are we ensuring that it meets all the standards required by the government? Is it registered in the right ways? Does it have the licenses that it's supposed to have? Because you may not be compliant today, but one time they could come and close your organization due to compliance. And also it could be a risk for you to get donors. Then we'll finalize with risk assessment, and here we'll look at the risks that one can have in an organization and different mitigation strategies they can come with to address these risks. So do you transfer this risk to someone else or another organization by maybe having insurance, or do you put some checks into the organization in that regard? So that's how our 3 days will look like. And I think we can now get started with today's session. So starting with today's session, this is how the agenda will look like. So we had the welcome and introductions from different participants. So now going to why financial management, look at the key elements, principles, building blocks, tools, and then we'll finalize with a Q&A, and then we'll have next steps shared by the LightUp Impact team. So yeah, to get started, I'll just, the team will be sharing a pre-session survey in the chat, and you should just support us to fill that information in, because we want to see where you are at in terms of financial management, and also see what other areas we can maybe try to support you better to ensure that we tailor these sessions to some of your needs. So I believe the link will be shared in the chat now, and just try to fill that in as we move forward. So I will just start with what's the first word that comes to your mind when you think of financial management. So I will hand this over to the participants, to the audience, to just share. So we could have maybe 3 people share about this. If you're in position to share, you just put up your hand and you'll be unmuted, and yeah, you can share about this, what it means to you.
As we wait for people to raise their hand, I see from the chat Joseph, who has written stewardship.
So we have two people who have raised their hand. We have Eve, and then we have Lorraine. So I think if you can go first, and then we give Lorraine the opportunity, and then the last one will be Alpha. So Eve, if Hosea, you can unmute Eve, or if you're in a position to unmute yourself, and then share with us.
To my mind is when I see financial, I see money and the rules that govern.
Thank you
Hello?
for sharing. Yes, we can hear you. Sorry about that. Thank you for sharing. I think Pauline can proceed to just collect their feedback, and then we can hear them. So next will be Lorraine.
According to me, financial management entails budgeting and also planning your finances for future use, for current things that you want to achieve. But the bottom line is budgeting for me. Yeah, thank you.
All right. Thank you, Valeria, and thank you to everyone that has shared. I believe we are spot on what we have shared. So basically, what financial management is, from your submissions, all this came through. So it refers to the strategic planning, organization, directing and controlling of financial undertakings in an organization. So you realize that as an organization, you're always going to have finances that you have to play around. And with these finances, first of all, you have to start by trying to strategically plan for how you're going to utilize this financing. And after you plan, so you have different activities based off also the money that you believe will be coming out, and also the expenditure that you will be going through that financial year. And after you've done that, then you start trying to organize the undertaking of these different activities. So for example, if an NGO, if you have a project whereby you're trying to, let me say, support smallholder farmers, there are going to be a number of activities that you're going to try to take on under there. So to support smallholder farmers, probably you have trainings on post-harvest handling. You could have trainings on corporate governance in their organization. And if you have these activities, then you have to now put budgets to them. And that's the part of organizing that and trying to put the budgets to them. And then you try to direct these resources to those activities that you have come up with. And then controlling is basically when you are at the tail end, when you're trying to now monitor if you have met what you actually planned. So you look at the actual versus what you had planned for. So for example, if you had spent, let me say, spend 60,000 Kenyan shillings on an activity, after the activity is done, you have to go back and look at whether you are able to meet that target, or you fell short, or you went over it. And then you try to now come up with different, you come up with learnings on why that happened, and maybe you could have, the cost could have been lower that you had predicted compared to what you found in the market. And yeah, so it just helps you to plan. And then, of course, when you have these historicals, that makes it mean that in the future, when you're doing this activity, you have historical data that you can also base on in your organization. So that makes it really key for the activities that you try to take up on every single day. So the other thing, it also includes applying management principles to financial assets of an organization, which is an important part in fiscal management. So usually also as an organization, you're going to have a number of, you're going to start acquiring assets as it takes time. Of course, usually organizations at different growth stages, they go through different activities differently. So you'll find those who are able to start and they have maybe some money already to them, and they're able to acquire assets that they need in the organization. And there are those also that take time to also acquire these assets as the time goes by. So you realize to try and move through this process of acquiring these financial assets is something you also have to plan for, and there have to be some management principles. You have to know that with the cash flows that are coming into your business, do these assets actually make sense to you? Are you going to buy an asset that's going to be redundant, that you won't need? And one thing you should also remember is these financial assets always undergo depreciation. So as you try to acquire an asset, you have to know that you really need this asset, because if you buy this asset and you don't utilize it, then it will still incur the depreciation. And there are assets that even depreciate faster if you're not even using them. So you have to really ensure that your cash flows support it, and it's something that's actually required for your organization. And the final thing is, it's just a statement that we try to come up with. So NGO financial management is likened to a car's upkeep, requiring regular maintenance to ensure optimal performance and prevent breakdowns. So financial management is not something that you should wait to do at, let me say, a specific point in time. Let me say, you'll say, maybe, because you'll find organizations whereby they'll say, maybe every after 6 months we do this financial management. That's not how it's supposed to be done. Financial management is something that should do on a daily basis through your organization. Every day you should know what expenses am I meeting, and do they reflect to the revenues that are coming or the incomes that are coming into an NGO. So NGOs will always also have different sources of income. It could be other income, which will be now the grants, the different funding opportunities that they get. And you should know whether that income that's coming in actually makes sense for the daily activities that you're carrying out. It doesn't make, and if you're doing this on a day-to-day basis, you're able to see that, okay, we have this amount of money. Let me say we have 200,000 Kenyan shillings that have come in, but the rate at which we're utilizing this money, it won't take us, let me say, the 3 months that it's planned for. And when you're able to have that on a daily basis, then you try to put some checks in place to ensure that you're able to survive with this funding. So you're able to now see, how do I now stretch out these activities? Can I do some on a weekly basis? And can I take some out that may not be necessary as the time goes by? So that's basically what financial management tries to look at. And we shall now go into why financial management. Why is it a topic that LightUp, Impact, and KCDF are trying to really push into your organizations? And this is because of various ways. With financial management, the first is you're able to make informed decisions. So if you know that you have a certain level of income coming in, and you may be trying to expand to a different location, and you're trying to, let me say, take on you need new staff that can be able to run your operations, your cash flows will support you to make that decision. You will be able to see that with this income coming in, if I get another staff into the organization, can I be able to pay, let me say, their monthly salary? Can I be able to pay their expenses of, let me say, transport, to be able to do these activities? So it supports you to make those informed decisions as you go on with these activities that you have planned out for. Many times I'll interact with the organizations, and you'll find that people are making decisions without any numbers. They're just using numbers off head. And this is usually because you have not been keeping any records at all, so you don't have any historical data that can be able to back up what you're planning. So if you're even able, because one of the aspects of financial management is budgeting. So if you've gotten a grant opportunity, you're able to budget that this is what we shall need to run this activity. And that also is already a way that you're being able to make informed decisions as you go forward. The second thing is it helps organizations in financial planning and acquisition of funds. So I believe as your NGOs, you have so many plans of what you want to do as you go forward. The one thing that you should try to do is every year, try to have a strategy on why you're trying to go for at least that year. You should try to set targets. So if you have set a target of, let me say, trying to get funds of a certain amount, then if you have financial management systems in your place, you will be able to plan for these funds, and you also see how you're going to try to acquire these funds. So you could want to do certain activities, but currently your finances are not supporting that. And with financial management, that would show you that, okay, the income that you have versus the expenditure, we're not able to remain with a sum of a big proportion of funds. So we have to now see how we acquire other funds to be able to run these activities. And this also helps because usually as these grant opportunities are put out there, and as you go to apply for these grants and maybe pitch for them, the one thing that they will always ask is, how are you going to utilize these funds? So if you have these systems in place already, you already know that if I'm getting, let me say, 1 million Kenyan shillings, I'm going to use it for ABCD in my organization. So that also goes into the third point of strengthening the ability to fundraise, because the donors will see that actually you know what you're talking about, you know your numbers, and you know what you're trying to do for the foreseeable future. The other thing is it minimizes fraud, theft, and misuse of funds. So many times, I believe you've seen this in newspapers all over the country and also globally. You find that organizations are misusing funds. There's fraud from different employees and theft. And you find that at times, these things that get to be known after, let me say, a 5-year period. And you should ask yourself why it always takes a 5-year period. That's usually because the financial management systems in that organization are weak. So someone can be taking out money on a daily basis, but you're not able to notice. If they are doing it in a smart way, they are trying to phase it out. So you rarely notice this if you don't have financial management systems in place, because you don't have an idea of, let me say, the income that came into your organization. You don't know how, you don't have records on how that expenditure has been done all over a point for you. Most organizations just focus on, we're doing this activity, and they will just spend the money on that activity. Anyhow, not knowing that there are so many leaks while trying to do those activities by, could be the staff or any other party. So if you have those systems in place, it won't take you a long time to realize that, because right now the world that we are in, this is something that's happening so often. There's actually a business that are supporting whereby they are trying to do, they're doing honey. So they manufacture honey, and they are in the honey value chain. So they manufacture honey and try to sell it to different farmers. But some of their staff who are in charge of marketing, they were in position to take out about, I think it was about 2 million Kenyan shillings over a time period. And they had a smart way they were doing that. And by the time she noticed, it was really late. And when we went back to do an audit, realized there were not any financial management system in place. So we have helped that business try to develop those going forward. And yeah, the other thing is it enhances accountability to donors. So usually with all the grant opportunities that are out there, because I've actually worked with a number of organizations. So like World Food Program, we had a call whereby we were trying to give out, while we were providing $50,000 to a number of SMEs that were in vulnerable communities to try and support them there. And one thing that we realized was most of these SMEs and NGOs were really struggling to report on how they've utilized these funds. So we'll try to come up with templates that can support them on that, to ensure that there's that accountability to the donors. Because if you realize, usually donors, they will provide the money to you, but they just want to see the impact that you have created. So if you don't have these records on how you have spent this money in the different communities, then it's hard to show the impact that your organization has created. And that now makes it difficult for you to get the next granting opportunity, because it raises a red flag if there's no credibility on how you're utilizing the funds. So it also encourages compliance with donor policies. So different donors have different policies that they will want to instill, and compliance is something that we'll look at in our last session. How can you be compliant in your organization to ensure that you are in position to enhance your organization in everything that you do? And then it increases financial sustainability. So financial sustainability is basically trying to ensure that your business is able to evolve as time goes on. So you have to try to assess your business that in the last 5 years, where were we at and how have we moved to now? How have our finances grown? Are we able to be sustainable for the next 5 years as well? So you try to look at those areas, and then you try to utilize resources more effectively, because if you have these checks on the money that's coming in, then you're able to use these resources effectively for the activities that you have really tried to plan out for. And it also supports organizations in making critical financial decisions. So because in the life that we live right now, it's always rare for you to have all the resources that you require. So with financial management, with the limited resources that you have, you are in position to know where should I first put the money at, which is the highest priority need that we need to address as an organization, and which is of least priority. So with that, you're able to know that. But if you don't have those systems in place, you will just find yourself even spending money on a number of things that maybe you didn't need in your organization at that time. So maybe you buy an asset that you're not going to utilize at that time, and that will now affect what you can do with the other activities. So mainly those.
Only,
Yes.
just to let you know on time, you have 5 minutes.
Okay. So yeah, basically you just need to know, those are the reasons of why we try to have financial management systems. And we'll now look into the key elements of financial management. And here we try to look at if you are trying to have a good financial management system, what are you trying to look at? So usually strong financial management requires that NGOs ensure that they have necessary personnel, processes, and procedures in place. So many times you'll find an organization with all the resources, but maybe they are understaffed and don't have the necessary personnel. And that's because they have not looked at their finances to know if they can really afford these people, or if they can't, and how to acquire them into the organization. So financial management processes should ensure that there's clear financial responsibility in job descriptions. So with the accountant that you bring in, you need to know what are their responsibilities in their day-to-day operations, and it should be really clear to them what they're supposed to do. They should ensure that NGO operates within an annual budget. So remember, as I told you, usually at the start of the year, you should have a target of what you want to do that financial year, and it should be quantifiable. So if you have that target, you're able to come up with a budget of how you utilize the resources, or how you try to get more resources. And then another thing is appropriate financial policies and staff being well trained. So we always have to ensure that we have sufficient financial policies in the organization, and try to also support our staff to grow, to ensure that they move to the next step. The other thing is every effort is made to act in an efficient and effective manner. So when you have this system in place, you should have to ensure that it's efficient and effective. Does it have any leaks, and how are you trying to have any preventative measures into the organization? There should be a system in place to track all income and expenditure. So how much is coming in, how much is going out of the business, how is my cash flow looking? Is it a good cash flow, or is something that I wouldn't even want to look at? Then timely, accurate, user-friendly reports should be available. So of course, as you will look into financial reporting, but usually as you're trying to look at the draw up financial reports, your financial reports should speak to what your stakeholders are trying to look at. So you should have financial reports that can be interpreted by all your stakeholders without any difficulty, and they should also try to be accurate. Then if you have donor funds, they should only be used for intended purposes. I've seen this happen so much whereby people divert donor funds to other activities, and that's why you realize most of the donor opportunities right now are becoming restricted donor opportunities whereby funds cannot even be moved to any other activity. And that has been just to try to tap into the checks or the loopholes that a number of people were going through. And then there should be donor approval. Donor approval should be sought before changing any project. So if you have been provided with money to do a certain activity, before you try to do something else, you have to first seek that approval. Then regular variance reports are provided to managers and boards. So that's basically what you planned out to do versus what the actual looks like. How are you trying to ensure that that didn't vary by much, and if it did, what was the reason? And then internal control procedures developed and operating. So internal controls are usually checks. You're trying to have checks in your organization to ensure that you're able to see these things as they have. So they could be preventative, or they could be preventative internal controls whereby you ensure that these things don't happen, or they could be some that you adjust when you see things are happening in the organization that don't give you a good look. And then you should have some audits conducted by independent qualified accountants. This is a challenge for many organizations. And of course, if you're doing audits that are not accurate, then that's not helping you at all. And then systems in place to ensure NGOs adhere to all financial and reporting requirements.
Just to react on what you have discussed, it is really elaborate, and I appreciate the information that you have passed on to us. But from me, just to inquire, based on my experience working with different organizations at different levels, and also the organization size, I realize that small organizations face challenges. They might be having clear policies in place to regulate the financial activities. But the challenge is it relates to understaffing. Say in a finance department, you might reach when there is like 1 or 2 staff in the finance department. But when you try to look at their financial policies in place, they are a bit not telling. So that one becomes a challenge for such an organization. So for that case, me, I just need to hear from you how you can guide such an organization how it can move. Thank you.
Yeah, basically, as an organization, as you go forward in everything that you try to do, of course, the first thing will be trying to have those different financial management policies in place. But you will find that now the challenge comes in trying to now instill these policies into the organization. So you will find that at times, because these policies could have been developed over a period of time, and once they are brought into the organization, they don't have to be a lot of mindset change to the staff in your institution. So this is something that is usually of a lot of difficulty. So the mindset change, how do you shift, let me say, your finance team from implementing it differently to now the new policies that you have put in place? Because this is something that I've gone through when we were working with a number of member-based organizations. So as we went to try and instill financial management systems in place, so for example, just record keeping, we found a number of them had even the tools to actually have financial management systems in place. So they had the receipt books, they had the invoice books that they could use in the organization, but you would find that people were just not using these tools. So I think it all first goes back to trying to change the mindset of your staff. And this it's always a slow process. And you just have to have, let me say, training sessions or coaching to these individuals to show them the direction that the organization is trying to go to and how that can really affect the growth of the organization as well as them as individuals. So when we try to do that mindset and change management, we realize that we are able to actually get the results, and people were always in position to now start using these tools. And the other thing that we also tried to do was to ensure that we had pulse checks on how they are using these tools or how they are instilling these policies. So this can be done on a weekly basis, or sometimes can be done on a monthly basis based off the policies that you're really instilling in the organization. In terms, if it's a policy on, let me say, record keeping, can be something that you try to first have checks every day on whether they've really recorded down all the transactions that have taken place. And you could always also start with a simple, you could always start by having a simple record template that they can fill in, which is not really hectic, because all this is usually a step-by-step process. Why there's also usually difficulty is you will find an organization has, let me say, brought a financial record system that's so complicated that these individuals cannot really instill or do not have the skill set for. So it's always also a process whereby you start from having simple tools instilled through the manual record keeping, and then with time you can, if you have developed these skills, then you try to advance it over a time period. So before you know it, they will be up to speed, and we'll be able to now maintain these financial policies in the organization. I hope that answers the question that was submitted. Are there any more participants that would like to share on this, or we could just move forward?
Hi, Colin. Maybe you can answer briefly in a few minutes, just two questions that I saw in the chat. One is, how does the NGO plan for long-term financial sustainability look like beyond the donor funding? So this is one question. And then the second is, how does an organization implement these financial principles that you talk about when you don't have funding?
All right. Thank you, Valeria, for the submissions. So the first one about sustainability to actually move away from the grants, that's actually a question I like a lot, and it's always something that we actually try to push most of the organizations that we support to go that route. So you will realize that a number of organizations, or maybe a number of NGOs or even SMEs that we have worked with, are really focusing on just having grants in the organization and just utilizing these grants the whole time going forward. And it's always hard to have sustainability in that, to try and grow your organization, your business, or your NGO. So that's a very good question, because it's always good to now see how do you transition to the next step. Because I'll even just look at an example of currently how USAID projects have been put on hold because of the whole situation that's going on in America. And you realize that a number of people have been laid off, or a number of projects have come to a still because this funding has also come to a still. So most organizations have been affected, and probably that's because they have not been really trying to prioritize having other incomes. So the one thing that I always say is grants should be always good to, let me say, push the NGO to try to push the NGO to the next level. So there should be really something that supports you at the inception. And then when you get off your feet and you're running, then you have to now start thinking of ways. You have to start innovating. So this is always different in different NGOs or different organizations. So it will be really based off the activities that you're doing. You have to see how do you now try to start maybe monetizing these to ensure that you have income to support the operations of your organization. So, for example, if you are currently supporting smallholder farmers, you have to now try and see in these trainings that you are, let me say, doing, how can you try to, let me say, create incomes from this with the post-service handling that you're providing? Can you maybe come up with a system that can enable you have incomes coming to your organization? So even we'll find that a number of organizations try to reach out to us to support them on trying to build their revenue models. So in that revenue model, you have to just do an audit of your organization and try to see areas that you can try to monetize and to be able to support your activities that you're going to carry out. So it could be things like you could start by, let me say, if you're implementing an activity whereby you're providing services to these farmers to develop their products, you could start by maybe trying to instill a co-payment whereby, let me say, the NGO could pay 60% of the cost of these services they're providing, and maybe they could also provide 30%. So you realize you have some income coming in there. Of course, usually when you're also supporting these different groups, you also have to first look at how they will try to, how they'll welcome that. Will it be something that they'll adopt, or will it be a challenge? And yeah, through that, as long as you're able to show the viability of the proposal you're putting forward towards them. So I'm providing these services that are going to support you really develop your organization or try to develop your products that you are producing, then you'll find that with time, they'll start taking it up into their system. I think the second question was, how do you try to have financial management systems when you do not have funding? So there are always templates that you can start creating even without funding. There are always templates that do not cost you a thing. So for example, I'll use an example of record keeping. So if you're doing record keeping in your organization, if you're trying to instill record keeping in your organization, you could just start by having a template that shows the money that's coming in your business and money that's going out of your business. So in accounting, we usually call that a trial balance. So it will have the debit side and also the credit side. So you can just have a simple trial balance, and that trial balance, why it's called a trial balance, is that at any one point it should balance. So you should try to ensure that the income that's coming in directly meets the expenditure that's going out. If at any one point the expenditure is higher than the income, then you know as your organization you have a problem, and it's something that you should try to address it. You cannot try to spend money that you do not have, because that will now mean that the money that's coming, that money that you are spending at a certain point in time could actually be coming from your own pocket. So I think when we even go forward in these training sessions, we're also going to try to look at how do you try to separate personal finances from finances of, let me say, your NGO or those of a business, because it's something that people struggle with, especially if it's an NGO that's starting up, whereby you could be the only person. You will find yourself putting money into this NGO without even realizing, and that's usually because of not having this trial balance instilled. So there are all sorts of, there are templates you can be able to create that won't cost you money, especially as you're starting out. And of course, as you go scaling up, then you see if the activities have increased or the number of expenditures and the income that's coming in is higher, then you now try to see if now automating these processes is something that's viable to you. So yeah, I think that's how I would share with those two questions. And
thank you, Colin. I think for the interest of time, we can proceed.
Okay. So the next slide, we are now looking at the principles of financial management. So under principles of financial management, we try to see, as you are having these financial systems in place, what principles are you going to try to maintain to ensure that everything is in position to go smoothly? Because because this financial system that you're trying to put in place will only make sense if it follows all these principles. And the first is accountability. So usually as you are doing, trying to instill a system, it should be accountable. So for example, if you are having this a financial system that's focused on, let me say, record keeping, you're going to ensure that there's accountability in how these records were done. Because at a certain point, it will not make sense if these financial records do not actually give a clear picture of the organization. So I've actually, in my experience, actually in the Ugandan space, this is a challenge whereby we're realizing a number of financial auditors that come and do audits for financial organizations are not doing this process well. And it has led to a point whereby a number of programs are now starting to say, if we're going to look at, let me say, your audited financial statements, then we're going to need them from a number of auditors that are industry verified. So this has been because most of the financial audits that are coming in are not actually making sense. So one example I will give is there is audited accounts I was looking at whereby this business, they made a loss, but based off how the audited accounts were done, it wasn't able to come out properly, and they actually had, the audited accounts showed that they had a profit, and they ended up even paying tax, yet ideally the business was not even able to make, the business in that financial year made a loss. So those are some of the consequences that happen, whereby if your records are not up to date or do not have the accountability to it, then it's going to be challenging for you, whereby you're going to meet expenses that you were not supposed to meet because things look different compared to how they actually went through in the organization. Another thing of accountability is here we're trying to now see how are these systems able to support you to also make financial decisions in your organizations. So with all the budgeting that you have done, you will be in position to see that with this budgeting, then I can be able to acquire this asset and I can be able to utilize it for ABCD, and it can be able to support the organization now move to a different scale. So the other principle is transparency. And transparency is mainly everything this system does. It should be something that you could share out there and know that you do not have, there won't be any consequences. So you'll find a number of organizations have supported, you'll find, for example, if they have audited accounts, they have different sets of audited accounts. So they'll have audited accounts that they give to, let me say, the different compliance bodies. And then they'll have audited accounts they give to, let me say, donors. And then they'll have audited accounts for different stakeholders. But if you realize that's not transparent, because you're just trying to manipulate the system, trying to see what different people are trying to look out for. And at the end of the day, this will always be this will always be found out after some time, and then it will not be a good look for the organization, and you could lose different stakeholders to your business that have been supporting you, or if you have different investors in your business, they could walk out on you just because you're not being transparent. So in everything that we try to do and aspire to do, let's try to ensure that all these budgets are transparent. We're not creating a budget for different stakeholders. Let's have one budget for all, one budget that's for all the stakeholders of the organization. Another thing that we'll look at is consistency, sorry. And under consistency, we're trying to see the different financial management processes that we're putting in place. Are they consistent over a time period? So what we were able to do last year, is it the same as this year? Will it be the same as the next year? So that's how we try to look at the consistency principle of financial management. Okay, so yeah, under consistency, that's what we try to look out for. So we should ensure that the different methods that we're using for budgeting, if we're drawing up different financial statements, all the procedures that we're following are consistent and they are the same across the board. So integrity is basically, this system should try to have the element of integrity, whereby you're trying to see that, is it in position to provide the much needed results. So different financial records and the reports must be integral to the organization, and let me say the different goals that it set out to achieve. So both managers, the board, and all the different stakeholders should try to ensure that they have policies in place that are integral to the organization, and try to really bring out the different objectives of why it was set up to. So let's not have financial systems that try to now bring down the integrity, whereby you're trying to now have, let me say, different budgets for different stakeholders. So yeah, that's how integrity tries to come in as a principle of financial management. So viability is basically, we're trying to look at the long term, the sustainability of this financial system. If we have a financial system today, will it be in position to give us the much needed results to ensure that the organization is able to scale up going forward? So here we look at the sustainability of this system. How will it support the NGO on its mission? So that's what viability looks like. And we have now stewardship. Stewardship is trying to look at, now you're trying to look at the different systems that you have put in place. How do they also try to meet the mission of the organization? So the actual expenses versus the planned expenses at the end of the day, how does that try to really support the mission of the organization? And the final one is accounting standards. So under accounting standards, here we're trying to look at, because there are different accounting standards in accounting. So if you have a financial management system, you have to ensure that it conforms to these standards that were set out. So these are usually international standards. And also, as you interface with different investors, you realize that you at one point have international investors coming into your organization to try and support it. And they will have to see if these accounting standards have been really put into place. Are you having, let me say, financial audits at the end of every financial year? Are you also having internal audits to ensure that everything you're going through, all the processes you're going through, adhere to these different accounting standards? So those are what the principles of financial management actually try to look at. So we'll after this, we'll just now try and look at the building blocks of financial management. So usually the building blocks of financial management, they are different people have tried to come up with different blocks of financial management, but those we try to come up with that were relatable to NGOs are these 4. And these building blocks are basically what you should try to ensure your financial system tries to comprise. So I'll start from financial planning. So as you're trying to build up a financial system in your organization, the first thing you should try to aim at is the financial planning. So as I had earlier, I think, talked about financial planning, it's basically trying to set out different activities that your organization will try to be looking at, both in the short term and the long term. I believe as NGOs and as the participants, as we are on this call, we all have plans that we want to see our organizations go through 2025. And also it's always advisable to also try to envision that in the next 3 or 5 years, where do I want to be? And if you're able to envision that, then you're able to come up with a financial plan that shows what are the activities I'm going to go through and what are the different activities that I'm going to have to try and spend on. So by now, if maybe you haven't come up with an objective for this year, it would be crucial for you to come up with that, to know that, okay, this year my strategic objective is to, let me say, if you're trying to, let me say, reach, if you're supporting smallholder farmers, your objective could be, we're trying to reach 3,000 farmers and improve their livelihoods by the end of 2025. So when you look at that, then you come up with the activities of what activities am I going to try to instill in the organization to ensure that we are able to reach this goal. And then you start breaking them down. You would find that maybe you need to bring on some staff on board, and then how are you going to compensate them? You realize maybe you have to do mobilization to these different farmers, and how you're going to mobilize them. There are going to be different costs to that. To also do these activities, you're going to need income for your NGO, your organization. So how are you going to bring in this income during this financial year? What was brought forward from the previous financial year that maybe was not utilized? And maybe for the previous financial year, how did those targets look like? And how are we going to try and better those? So once you understand financial planning, then you go into now accounting records. So accounting records is basically for every activity. You're going to try to have different records in place. So if you're doing mobilization, you have to show that these are the costs that I have incurred during this activity. And you also try to look at what impact has been created through that mobilization. If at any one point you see that, because now this will help you to know if this activity is actually something you should go forward with, because it will give the required results, or it's not something that you will go forward with. So under accounting records, you would also try to come up with different financial statements. So that will be, we have the income statement, or what's called the profit and loss statement. We have the balance sheet that tries to show what the assets and the liabilities in an organization look like. And also have the cash flow statement that looks at how cash is moving through the organization. So under there, you also try to look at the different, how you draw up now these different financial statements based off the accounting records that you have been keeping the whole time. And after that is done, you go into now internal controls. So under internal controls, you try to look at, under internal controls, try to look at the different checks that you can have in your business to prevent or mitigate a number of risks. So as earlier as I shared, you realize a number of times certain things in an organization that were risks for a long period of time are figured out after, let me say, the organization is no longer performing well. And that's when people try to now do checks on why in the organization, and then they find out the different manipulations, or it could be fraud that was undergoing in this under the organization. So if you have internal controls, you try to have preventative measures to ensure that these leaks do not go through in your organization. But also certain times you could find that you don't plan for everything. So at any one point, if you see that there's something that was not a risk maybe before that has now leaked through your internal control system, then you try to see how you have various checks, how you try to now instill better systems to ensure that you are preventing that different fraud, could be theft in your organization. So internal controls basically tries to focus on the risks that your organization is interfacing. Could be internal risks, it could be external risks, and you have to know how you try to maneuver those should they present themselves, or how to get to know of their existence as early as possible. And the final step is financial monitoring. So as you go through this for this whole building block system in your organization, the final place now comes financial monitoring. And now here you're trying to see what was let me say what were our planned activities, what were our planned expenditures, and what have the actuals looked like. So if we plan to, let me say, have income of coming in of about 500,000 Kenyan shillings, then you try to see, did you meet that? Was there a variance? Did you go over that or below that? And how are you trying to ensure that that variance doesn't happen going forward? So under financial monitoring, you now try to assess where your organization is at. So this could also entail both internal audits as well as external audits. So always we try to come up with different audit checks in your organization, both internally, and at the end of the financial period, you have to also provide these. You should give an external auditor the opportunity to now have a look into your business, and then they will always advise on what you could have done better, or what systems that you're not currently instilling, and that always helps you remain accountable to everything that you try to do. So those are the 4 building blocks of financial management that try to ensure that there's financial control in your organization. And we'll go into a breakout session or an activity. And here you could just share what you think is the most critical building block for effective financial management. So we'll just be listening from you, or you could just type in the chat to see how we can better support you to understand this, because this is something that is very key to understand in your organization. So we want to try to spend some time on this to see how we can better it on your end. So you could raise your hand, and Valeria will also be reading a number of comments that we'll be going through in the chat. So I'll just pause for now.
Hi, Colin. We have some comments in the chat, as people maybe also want to raise their hands. Sophia is saying financial planning is the most critical. It gives a sense of direction to all the other building blocks. Do other participants have different thoughts? Please type in the chat or raise your hand. Thank you. Thank you, Philip. Philip Ongeri is telling us, I think all the blocks are important as each block seems to build the other. Again, George says the same. They're all equally critical because they all depend on each other. Thank you for that. And I see that Josfat believes that internal controls are the most critical. Any comments on your side, Colin, as we wait for the other participants? Internal controls is key again. I see more comments on financial planning is more critical, and others say, again, what has been said, that they're all important. Financial planning is key from Helen. They're all important, but financial planning is very important. And Lukwagana is asking Charles, are these blocks to be sequentially implemented? Maybe you can shed light on that, Colin.
Okay. Thank you, Valeria, and thank you all for your submissions. So yeah, I'll just go back to the slide with the building blocks. So yeah, usually I'll start, I think, with the last question, then I'll build into priority, which is more important. So usually you'll find that as an NGO or any organization, as you start out, it would be ideal to have all these 4 blocks in place. But also you have to understand that at times you have to pace yourself on how you try to achieve this and how you try to build them in over time. So usually all these blocks are actually important because, let me say, if you're maintaining financial records and you're not, let me say, monitoring to check if these financial records were done properly, if they were accurate, if they had the integrity to them or the transparency component to them, then that means the accounting building block will have failed as well. So all these 4 try to play a crucial step in your organization, or they are of high importance in the organization. So you should try to implement all of them. But of course, as different organizations start at different levels or are at different levels, you can start by trying to instill them as you move forward. So for example, you start with financial planning. Here you try to understand how am I trying to have these activities in the organization done? Do I have the finances that I require? And how does that now build into the accounting records? So if I've set out these plans for the organization, then you need to know how you are actually spending on those plans. So you have to ensure those transactions are there. If you've been able to purchase an asset, you need to know how fruitful it is for your organization, or the depreciation rate that it's currently undergoing. So those accounting records would have to also be done trying to follow the principles of financial management and also the accounting standards. And then you go into the internal controls. So you realize it all moves as a step. So if you have these internal records, then if you have these accounting records, then the internal control point enables you to check that has there been any leaks through the organization? Has there been any misuse of the funds that we had, and how we're trying to address the different risks of us doing these activities? So you could have different activities, but you should know that at any one point, every activity that you take on, there will always be a risk that's presented to that activity. So the internal controls also now support you to know how you're going to try and mitigate those risks. Do you try to transfer them to another party, maybe through insurance? Do you come up with systems in place to ensure that your internal controls are better? So I'll give an example of how you can have a risk assessment in your organization. So let me say your organization is a circle, and this circle, they have different people that are coming to say, this circle is supporting, let me say, smallholder farmers, and these farmers are coming to save with this circle and are providing the funds, their monthly savings or weekly savings to this circle. So there are always going to be risks in that this circle at one time will start now lending out this money to these different farmers to probably instill into their different activities. So you'll find farmers may need, let me say, inputs for when the planting season is on, and to buy these inputs, they'll come and get loans from the circle. So as the circle, you have to realize that am I giving her these loans at fair interest rate, or is it too high for the farmers I'm trying to support? So if it's too high for the farmers, or if it's also just you think it's fair for the farmers, there's always going to be a risk of default, because a number of these farmers could plant this seed and maybe the season doesn't go as expected and they are unable to pay. So there's that risk of default. So how do you now try to tap into that risk of default? Because other farmers will also need these funds at a certain period of time. So a risk mitigation strategy you could come up with is maybe when these people are coming for loans, you'll find that these circles will ask for, let me say, a guarantor in place, or maybe they could ask for some collateral in place to ensure that there's that check in that in case you are unable to pay, there's still somewhere else that they can be able to get their money back. So those are that's a way of which you can look at how the different risks come up in your organization, and how do you also try to mitigate them. If you have purchased an asset, let me say a motorcycle, to support you on the different mobilization efforts in your, let me say, in your NGO, trying to support still these smallholder farmers, you realize that also this asset has a risk of, let me say, theft, or in case it's involved in an accident, it could all just diminish at a go. So now how do you try to address that risk? Maybe you transfer it to an insurance company who insure this motorcycle for you, to ensure that when this happens at any one point, you have a backup plan to ensure that that's mitigated. So as you also try to think about the risks that are in your organization, you also have to look at you have to get to know which are of high priority and which are medium priority. The high priority risks are those that you should always look at and say, this could affect all my operations at a go. And you should now try to come up with different mitigation strategies. So you could always have someone support you do a risk assessment and develop a risk framework that enables you to ensure everything has been looked at from also an external point of view. Because you will find a number of, let me say, investors that would want to invest in your organization. They're going to also first try to look at what risks your organization has, and if these risks have been mitigated, and if it's not something that they really mind. So yeah, that's how all those blocks come into place, and all of them are really crucial. But if you are at a different step of growth, then you're going to have to develop them as you go forward. So you have to start with one. Once that's complete, you go to the other, but you just have to have that vision of, I have to have these systems in place, let me say, by the end of the financial year, and that will always help you. Because now financial monitoring usually comes at the end of the financial year to also try and show what the actual picture looks like versus what you plan to do going in your whole process of the year. So yeah, I hope I've answered that. So we'll go into what will be our final topic of the understanding financial management. And here we are just looking at different tools that we can implement in our organization to try and have a nice and robust financial management system. So these tools, if you can see there, we try to break them into 4 groups. So there are tools that will be focused on planning. There are those that are focused on organizing, and there are those focused on controlling, as well as those on monitoring. So we'll start with planning. Of course, planning always comes at the inception, as you saw, under building blocks. And under planning, we have different tools that we can try to put in place to ensure that all our plans are able to come out properly. So there will always be a strategic plan. So a strategic plan basically just looks at your strategy of a financial year. So it tries to look at where is your organization trying to go in this financial year or for the next 3 to 5 financial years. So under this strategic plan, it always has an objective. So you come up with a strategic objective, which would be quantifiable. So this strategic plan this strategic objective should be quantifiable. As I've given an example, for example, you say for this financial year, we're looking at supporting 1,000 smallholder farmers, improve their livelihoods by, let me say, improving their incomes from, if you have done an assessment and let me say their current incomes in a financial year about, this is just it's just an example, if their financial incomes of a year about 50,000 Kenyan shillings, then you could say you're trying to improve this to, let me say, 100,000. So to now try to improve that, then you go into the different activities that you're going to try to implement. So you also have to look at different things like, does the organization have the technical competence? Does it have the financial competence? Does it have the commercial competence to be in position to achieve these targets? So technical, always look at things of like your team or the assets that you have on board. Do they support the strategic plan? If they do not, then how are we going to try to acquire more assets? Does the team actually have the knowledge on how to implement this strategic plan? If they don't, then maybe we're going to have to have trainings done to ensure that their technicality is enhanced. So that's what a strategic plan tries to look at. So our business plan it tries to look at now the projections of, let me say, your organization. So if last year your financial statements looked in a different way, you can use historical figures to now try to come up with what the future figures could look like. So the historicals, you could always look like you could look at the previous 3-year period, 3 to 5 years, and see what your financial statements have looked like, and you try to do projections of where your organization could be at in the next year or the next also 3 years. And then that will help you understand how you're going to have to implement to ensure that you also achieve your targets. So there's now also another tool, which will be the activity plan. And the activity plan is basically how you try to phase out the different activities that you do in a financial year. So you say, let me say in Q1, we have these activities phased out, and you should also have budget items to them to know how much you intend on spending on those. And that could be, so you could break that down into quarterly, or you could break that down monthly just to have that sort of accountability to yourself. Because at times, if you make activity plans that are for a very long-term period, then it becomes hard to have that accountability to it. So you should always try to ensure that your activity plan also tries to really focus on the short term, to know whether things are going as you plan them to go, or there's something that you have to now do to address that. And then cash flow forecast, here you're trying to look at how much money do I plan to be coming into the organization, and how do I plan to spend this money? You could also look at the historical year and say how much money maybe came in that was not utilized, and how can we move this into the next financial year. So those are the different tools that one can use under planning, and we can now move to organizing. So here, organizing, you're trying to see that the activities that you have actually planned out for, you are able to actually implement them. So how do you try to organize these different activities? So it also supports in trying to ensure that your organization has also different people understand the hierarchy that also follows in this organization. So in terms of reporting, if someone has a challenge in, if a staff has a challenge in a specific component, who are they going to report to? And for that sake of, then it's also the financial team that's trying to implement the different activities. What things should they try to prioritize, and how are they also trying to do these activities? So under here, we would have things like flow diagrams. So a flow diagram usually just tries to see what the hierarchy of the organization looks like. So if you have, let me say, a managing director, do you have a CEO that reports to that managing director? And then under the CEO, who are the people that report under the CEO? So based off the stuff that you have, you try to come up with a flow diagram of the hierarchy of that, to see how you're going to now, how the different parties are going to now support in your whole vision. So there will also be the constitution. I believe the constitution will be, you're trying to look at what is your organization, what did you set it out to do, and what's its mandate. So under here, if you're able to know your mandate, it also becomes easier for you to now try to instill a proper financial management system, because you always look back at it and say, okay, we're trying to do this today, but does this try to follow our mandate? So for example, if you have an NGO that's trying to support, let me say, entrepreneurs to scale up their organizations and create more jobs, then at the end of the day, every activity that you come up with, you have to have that at the back of your mind. Does this activity try to fit into the mandate of trying to support these entrepreneurs, skill their, be able to skill their organizations, grow their organizations, and also create more jobs? Then we'll have the finance manual. And I believe the finance manual just basically looks at the different policies that you have in your organization. And as you are implementing your different activities, are you implementing them in a way that follow the different financial policies that you set out in your organization? And that's always done to try to see that the financial policies you have are actually instilled in the organization. So this is something that the finance team has to study it like their Bible. So they should always know that, okay, I've been asked to do this transaction, but how am I going to do it in a way that actually follows all the policies in the organization, to prevent that at the time that when we're having an external audit, we're now having issues coming up, raising concerns to the organization. And then part of organizing, you will find that there will also be the HR function trying to look at the job descriptions of the different staff. So I'm happy that you went through the HR training, I think last week, and you are able to know what the HR function looks like. A number of organizations do not treat the HR function as something of importance, but it also really supports the employees' welfare. So as you're coming up with these different job descriptions, because a job description will have what the staff you're bringing in are supposed to do, and also there will be things of like compensation under these job descriptions. So you can't put out a job description that has compensation that doesn't match the income that the organization is looking at, or the budgets that you had earlier tried to implement in the organization. So these job descriptions, as you're trying to do them, you ensure that the functions that this person has to do are commensurate to also their compensation, to try to prevent a situation where you have a high turnover because staff are overwhelmed and maybe they're not being compensated based on what the industry looks like. So they'll always be trying to now move to other, you'll find that there's a lot of turnover because they are moving to other organizations because they are overwhelmed. So that's what the planning tools look like. And that's what the organizing tools look like. And yeah, it's something that these are some of the tools you came up to see how you try to implement these in your organization. So we now move to the third one, which is controlling. And basically,
Just to notify you on time. Sorry for interrupting you. Just to notify you on time, we have 10 minutes.
Okay, all right. Thank you for that. So yeah, when you go to the controlling tool of financial management, here we're now trying to look at how do we try to ensure that the planning step, the organizing step, we're actually trying to control everything that goes in and trying to control the different activities that are undergoing in the organization to ensure that everything we're doing is up to our constitution. It matches the mandate that the organization try to set out. So under here, you'll find there will be things like procurement procedures. So if you are going to onboard, let me say, if you're going to onboard, let me say, a service provider for a specific task that you have, let me say if you're going out for a mobilization effort, a mobilization to a community, and maybe you need a service provider that will provide lunch to this staff and also to the people that you have mobilized, then what procurement procedures do you have to ensure you onboard this service provider in place? So a number of organizations also based off their cash flows, you will find that under their procurement, if they're supposed to pay the service provider, they will try to phase it out in that, let me say they pay this service provider after 30 days to ensure that there is good cash flow management in their system. So usually as I'm talking to different organizations, we have under the financial statements, we have what we call receivable days, and we also have what we call payable days. So receivable days is basically if you have provided a service to someone, how long do they take to actually pay for this service? And then payable days, if a service provider has provided you a service, how long does it take you to pay them? So at any one point as an organization, you have to ensure that your payable days are higher than your receivable days. So what that means is you should always try to ensure that you pay the service providers who have provided you a service, you try to pay them after a longer period than when you plan on getting your money back from the people you've provided a service to. So if your receivable days are maybe 15 days, you should now try to ensure that your payable days are longer than the 15 days, just to try and ensure that when you provide a service and the money comes into your organization, then you are in position to pay off the service provider that has provided you a service. So under controlling, that's procurement procedures comes under that, and you should always have procedures in place that ensure that your cash flows are able to make sense to avoid a period whereby you may be having to demand for your income for a longer period compared to how you're paying it out to the different service providers. Because I believe as NGOs, you have service providers providing you different services. Then we have the fixed asset register, and here we're just trying to ensure that all the assets we have in the organization, we have listed them out properly, and we know that days when we acquired these assets, the price at which we acquired them, and we also know the percentage of depreciation that incurs these assets every year, to be in position to know when to maybe dispose of the asset, or to ensure that you've gotten quite some value from the asset that you have had for a time period. So as you have the asset register, you're able to know that, do I need to acquire more assets, or what I have, is it enough, or do I have some redundant assets that I need to actually dispose of? And then under controlling, you have internal and external audits. So usually as an organization, as you come up with your different financial records, you try to ensure that these financial records, you are able to come up with different financial statements, and that's how you're able to have those internal audits. And at the end of the financial year, you bring in an independent auditor just to have that separate bias from the organization. And many times you figure out that there are times where your, let me say, finance team has undertaken procedures that maybe do not fit your financial policies. So if you're doing this routinely, then you're able to now know that going forward in the next financial year, we have to now instill better checks. And then we'll have vehicle policy insurance. So that also relates to if you have vehicles in your organization, what's the policy that you have on trying to insure this every year, just to try to shift that risk that I earlier talked about from your organization, to ensure that, let me say, if this vehicle undergoes an accident or it needs repairs, it's not something that is going to really disrupt the operations of the organization. And the final step we have is monitoring. And here monitoring, we're just trying to look at all the activities that we have done. Have they met the results that we try to achieve in this financial period? So if we plan to, let me say, create 1,000 jobs in this financial year, how have we done on that? So a number of times you even see different organizations putting out proposals for monitoring and evaluation consultants to come into their organizations and see how they've implemented various projects, and to also advise them how they can better do this. So you would find, like, let me say, an NGO, you are implementing a project that was trying to create employment opportunities or improve the livelihoods of different individuals. So you have to, or let me say, you're trying to support also smallholder farmers gain access to market, access to finance. So as the evaluation comes in, so they will try to see were you able to meet these activities and targets that you set out to achieve. So out of the 1,000, how many did you actually support? Did you go over and above? Did you double count, let me say, as a number of individuals? So yeah, that's just an area that we try to have checks on. Then we'll have, of course, audit reports. After an external auditor comes in, they will do an audit and they'll provide an audit report. And that enables you to now know that whether what you planned for the financial year period, you are able to meet it. Did you go below it? Did you go above it? And what could you have done better? What's the cause of that variance? So under monitoring, you're just trying to see what was the actual versus the planned, and how are you trying to ensure that this variance maybe is bettered or doesn't happen, what maybe went wrong, what are the learnings that you have been able to undergo as you've implemented this project. So there will also be project reports, and these are usually provided quarterly, some are biannual, some are annually, and these are usually based off the projects that you're implementing in your organization. You're trying to see how are the projects going? Are we meeting the deliverables that we set out, or are we unable to do that? And the final one would be donor reports. So if you have some grants that are coming into the organization, do you have reports that you can share with these donors that can be in position to ensure that you get the next opportunity from them? Will they be happy with the activities you've implemented, or it's something that you have to explain that maybe funds were directed elsewhere? Or so these donor reports should just try to ensure that you show the donors that actually the activity you aim to do, you've actually done it well. If there were any challenges, what challenges were there? Because at times also, as donors are also trying to structure all these projects, you realize there's something that they could have in project design that you try to implement, and then you realize that, let me say, the market that you're trying to implement it to is not really accepting them. So you have to try to change, because yeah, I've been able to do a number of donor projects, and I know there are times when you have to go back to the donor and also try to co-create on how you can better implement the project based off the learnings. So these donor reports just ensure that you have those learnings in place, just to have like proper checks in your system, in your whole financial management system and your organization as a whole. So yeah, those are the main tools of financial management that we should try to utilize going forward. And we'll go into the final activity. And here we're going to give you a bit of time to assess your NGO and point out 5 benefits of strengthening the building blocks of financial management. So I remember we went through the 4 building blocks. So here you just try to assess your NGO and then see what would be the benefits if you strengthen these building blocks in your organization. So I'll just go back to the page that has the building blocks, just so as you can have a reference point. And at this point, I'll just hand it back to Valeria to support in this activity. Some could come in as comments. So I think we'll provide about 5 minutes for this activity. Then we'll go into the final part of the session. All right, thank you, Valeria, for taking us through that session. So yeah, from the comments in the chat, I'm happy that I think this has been a fruitful training session, and the participants have been able to really understand how the building blocks build into the principles of financial management and also the importance of financial management. So once you have all these building blocks in place, you'll realize that you're able to have a proper financial management system in place. And when you have now a proper financial management system in place, you'll realize that the first slide we went through, why financial management, it all starts to fall together. It starts to all come up together. So you'll realize that when you have these building blocks, you're now able to make decisions for the NGO. So based off the accounting records that you have registered for a financial year, you'll be able to know that maybe the performance this period wasn't good, and we have to now try and better that going forward in the next financial year. What contributed to that? How are we going to put different internal controls in place? Because now also if you have all those building blocks, you realize when you undergo the monitoring phase, you get to know, let me say, the plan versus the actual, whether it went well or it didn't go well, and what are the learnings. So if you've had all these blocks in place, by the time you're at the monitoring stage, you already have an idea. And also, as you are going forward, you would know that this didn't go well, and you try to assess why didn't it go well? Was it because of ABCD, and maybe what could we have done better? Of course, at times when you're also implementing projects at the first time or in the first year that the project is being done, there's a lot of learning that your organization goes through. And it's always essential to now record those learnings to know how to maybe utilize them as positives for the next financial year, and ensure that you are in position to have an NGO that's meeting your mandate. So we'll just now go into the final session, which is a Q&A. So if you have any questions at this point, you can post them in the chat, or you could unmute and also just be able to ask the question. I'll be responding to those. And I think that will take about another probably 5 to 10 minutes. If there are no questions, then we'll just proceed to the next activity. So just...
We have questions. We have 4 questions from the chat, from Philip, Mary, Michael, and Iswana. So the first question from Philip is, how can financial control be successfully achieved? Which departments should be there and staff to achieve the same? So this one is from Philip. As I said, it's about financial control. How can they be successfully achieved, and which type of staff should be there? Mary is asking, under planning, must you use all the 4 plans, or you can have 2 or 3 of them? Let's say strategic plan, business plan, together with the activity plan and cash flow forecast. Then Michael is asking, is the business plan you talked about, does it work for NGOs or more for income generating projects under planning? And then at the end, Iswana is asking, Colin, kindly expand on the receivable days versus payable days.
Yeah, I'll start with the first question, which was how financial controls can be achieved, and which staff would you recommend to have on board. So this also varies based off what your organization is doing. So you'll find their organization also, it will also depend on the different stage that your organization is at. So is it at the early stage, is it at the growth stage, or at the maturity stage, or on the decline stage as well? So you have to first get to have an understanding of that, and through that you can be able to know which stuff that you will need in your organization. Usually you have to ensure that because usually financial management will be, it's a process that's usually done by the finance team, but at certain points you also, as an organization grows, you will realize there tend to be more needs. So at the start you will find that, let me say, an organization just has an accountant who is maybe doing all the processes of this organization. But as you go forward and maybe are implementing a project that's quite intense, then you start realizing that the accountant can't do everything, and maybe you now need someone for procurement. So you may need a procurement professional, someone who will handle like the different service providers. So there can, different service providers, because of course, as you're implementing a very heavy project, you realize that there are a number of service providers that will fall in place, and you need to try to maintain all this. At also a certain point, you will find that you will need someone who will do just basic administration of also the organization, and maybe you could also find you need more accountants in place who can also now support to do the internal audits, also try to come up with different risk frameworks or different risk assessments based off the risks that have been identified to a program. You could have someone that's also heavily supporting as a program coordinator for the project that maybe you are implementing. So usually it also depends on where your organization is at a certain period of time, but the need always tries to show you that. So that's why you should be aware when you're maybe starting to implement a project, which people would you really need on board. So yeah, that's how you can try to achieve different financial control systems in your organization. Then I think the other question I'll just go back to the slide of whether I should have all the 4 plans. So usually, and I think this question will try to dive into the question of whether a business plan is for profit only or for all types of organizations. So usually a strategic plan is most people at times try to confuse it with a business plan, or they try to merge the two. So a strategic plan will usually be the strategy of what your organization is going to try to do in, let me say, a financial year. So if you have a strategic objective that maybe I had mentioned about, of you trying to support 1,000 smallholder farmers, improve their livelihoods by increasing their income from 50,000 Kenyan shillings to 100,000 Kenyan shillings, then the strategic plan supposed to come up with the different activities that are going to fall under that strategic objective. So also usually the activities you try to come up with should be also quantifiable into this whole strategic objective. And the business plan will now try to it tries to now look at also the finances that you have as an organization, and also it looks at the historical performance of the organization and how it can perform better going forward. So also under business plan, you should know, it tries to, because here you also try to project financial statements of your organization or your NGO. And here you're able to know whether the performance of last year actually met what you had planned, of the previous years, how have you been performing, and how does that feed into your future plans going forward. And usually a business plan for it it's usually for a longer period. So business plans are set out for about a 5-year period. A strategic plan is something that usually people try to implement over a shorter term. So it could be always in a yearly period, whereby someone has a strategy that they're implementing in this financial year. But this strategic plan will always also now feed into into the business plan, in that it tries to support to know where your organization should be going in the next 5 years. So if you have a business plan of 5 years, your strategic plan, every year as you implement it, it should try to feed into what you have tried to set out in your overall business plan. So I don't think a business plan is something only for profit, because it has very many different elements there. Because of course, also investors, as they're coming into your organization, or as they're also providing to you a grant opportunity, they're going to want to also assess where has your organization been historically for the last 5 years. What have you been able to do? Have you been able to create impact in your organization? How has that inflicted into your financial statements? How has it also tried to look at your overall vision or mandate of your business, of your organization or your NGO? And Yeah, I think the final question was to expound on receivable days versus payable days. So I'll just start by saying, so what receivables are in any organization is it always comes about when you have provided a service or a product that is supposed to be paid for. So remember, as we're talking about the sustainability component, whereby as an NGO, you could maybe try to see how, when you're implementing your activities, you could try to see how you now become sustainable, to have also money coming in from different angles, or maybe you providing a service to be able to be in position to actually carry on more activity in your organization. So we talked about the cost sharing. So for example, if you of course shared this activity with the smallholder farmers you're trying to fit in, so you realize those smallholder farmers are supposed to pay for that activity that you have done. So at times there will be those that will take time to do that, and that becomes a receivable because you've provided a service, or you've provided a product to them that was not paid, that hasn't been paid for yet. So it's a receivable. So as an organization, you have to understand that usually how often does it take for these people to actually repay for this service that have been in position to provide. On the other hand, payable days come from payables, and payables will be you as an organization paying for a service that you have provided to let me say, an individual, or that as you paying for a service that an individual has provided to you, or let me say another organization has provided to you. So for example, if you are, let me say, supporting smallholder farmers by providing to them farm inputs, you are going to have to, let me say, look for a provider of these farm inputs. And if they provide these inputs to you, you're going to have to pay for them. So usually based off also your procurement policy, you have to know that for service providers, maybe I want to pay them after 30 days. So that means that you pay your service providers after 30 days, after they provided you with the service, or let me say the product as well. So that becomes a payable day. If they have provided to you a product or a service, but you haven't paid for it, but you pay for it after, let me say, 30 days. So the payable days of your organization is 30 days. So usually as you're doing this, you have to try to ensure that your receivable days are much lower than your payable days. So what that means is basically, if you are providing a service, they are paying you quicker compared to when you are paying for a service that someone has provided to you. So that helps in your cash flow management, whereby you're able to actually pay for these services that have been provided to you, because you have had that income coming in much quicker than you have had to pay it out. So that's basically how to explain it further. I hope I've provided clarity on that.
Thank you for the session. So thank you so much for joining us for this session. We hope to see you again on Monday, or for the second session, as Colin takes us through the second phase of this training. So asanteni sana and goodbye.